Investments in securities are subject to market risks. Read all related documents carefully before investing.
Hello and welcome to the Weekend Investing Daily Bytes. We are shooting this episode on 12th of May, and the markets awaiting the exit, the polling outcome in Karnataka, but there is no real reaction in the market. So market has been flat, but I mean there's neither fear nor any positive additionally positive move because of this. So this is a no event from the market perspective. The more important events are what's happening globally in terms of banks getting a bit shaky again in the US. Uh, Inflation is a bit lower than what it was earlier. But one thing that everybody needs to understand is that when you go from 10% inflation to 5% inflation, nothing has come down. I mean, if a good or service was priced at $100 2 years back, and last year inflation was 10%, then it went from 100 to 110, and then inflation went from 10 to 5%. That price of that good or service went from 110 to 115.5. So nothing has come down. Disinflation is very different from deflation, and what we are seeing is disinflation. So rate of inflation has come down, but that has not uh, you know caused anything for cheering or anything for really celebrating this fall of inflation, because interest rates have gone to 5% plus in the western world, and things are collapsing. So obviously when things are collapsing, the demand will get crushed, and inflation will come down. But what is the solution? It will go into recession, then again interest rates will be cut, again inflation will go up, again interest rates will have to rise. So we have uh, you know we are kind of finding ourselves trapped in this situation, and the best way to deal with this situation is to not really worry about absolute numbers. Everything is relative. Whether India market versus other emerging markets, whether one stock versus other stock, everything has become a relative game. So if some stock is at very high valuation versus other stock, then you only need to see the relative valuation. What is the absolute valuation of these two really does not matter, because the base of the monetary base itself is changing rapidly. The last 3 4 years, 75% of the dollars in existence have been printed, and many other currencies. So when the base goes up dramatically, asset prices will also go up dramatically. So you can only see the relative valuation of one asset class versus other, or one stock versus another stock within the equity. Absolute, uh, the absolute earnings or price earnings really has stopped making much sense, because your base of money, the money base itself, is changing dramatically. Anyhow, let's not digress from our daily episode. So Nifty came down to 18,200, trapped some bears into thinking that the market is going to go weak into this weekend, and recovered back in the second half of the day, closed above yesterday's closing. And this last 5 days, this current week, as well as 4 days before that, we've had alternate up and down days. If you see the last 9 candles, they have been alternate up down up down up down candles. So the absolute uptrend that was there is a bit shaky right now, but you would expect that some sort of profit booking or corrective rally is always due once a market has gone up 1400 points within a matter of 6 weeks. So from that perspective, even if the market comes down to 17,800 and then takes a deep up, that is also okay. Nothing wrong in that. Aisha Motors was the star of the day, plus 5%. post its results. Lot of red boxes you can see today: BPCL, Hindalco, JSW Steel, Tata Steel, NTPC, Power Grid, Adani stocks, L&T still continuing to bleed. Infosys, not many on the green side. Hindustan Lever has been extremely bullish for the last 2 days, also up 1.3% today. So, sort of a flattish day with some sparks here and there. Autos were the main leaders of the day at plus 0.8%. Private banking, consumption, PSU banks were other marginal gainers. But real estate, IT, pharma, infra, commodities, energy, public sector enterprise, and metals especially were the big losers for the day. So that one directional clean momentum that we had is a bit shaky right now. I'll give you my reason for that in a bit. Mid cap also did not breach yesterday's high. In fact, has closed below 2 days close. So it is still in that confusion zone near a top, whether it is going to be a top or are we going to go further, because we are very close to the all-time high on mid caps also. Small caps, which had you know gone past this important trend line yesterday on a very minor basis, has given it back and has closed below the trend line. So this is another uh, short-term red flag that maybe we are peaking out here and some more consolidation may be needed before the next one going in. However, Nifty Bank is giving a very different picture. Nifty Bank has closed at a highest all-time high weekly close, and on a daily basis also very near all-time high. So within a percent or so uh, to its all-time highs on a daily basis. So this is one reason which I feel is causing some weakness here at this stage in the Nifty, that we were expecting this dollar index to break down. If you recall from many episodes in the past, after we hit this mid-April and it was a clear head and shoulders pattern, I was expecting that this will break down, but it has not yet done that. And it is still consolidating at this 101, 102 levels. And that is the major reason I feel that, major momentum towards emerging markets, towards precious metals has not come because of the strength in the dollar right now. So as soon as the dollar starts to weaken, I think we will start to get more flows, and emerging markets and precious metals will start to go higher. So let's talk about the topic of the day. The discussion is around, high risk is not needed for making high returns. That is the topic that I want to discuss today. Usually we hear, unless you take high risk, you will not be able to make high returns. But that is somewhat of a fallacy, because you could break down your risk across hundreds of transactions, and in any one transaction you need not take a high risk. But if your strategy has an edge, then over every rotation, if you have an edge and you will keep repeating that edge over a long period of time, what you will see that the expected outcome, the expected positive outcome will add up and accumulate, and you will not need to take very large risk on any one transaction. So I'll show you how this would be done. So this was my tweet based on which I'm discussing this, that if you have an edge, you can take multiple trades with low risk and compound it over time and create high returns. And that's what any structured strategy, whether it is weekend investing products, whether it is stairs product, that is exactly what they're doing. So just for a quiz, as a quiz, you can reply in comments if you like, that what do you think is the answer to this? Can you have a negative outcome with a big win rate of 75%? So you do 100 transactions in a year and 75% go right, only 25% go wrong. What do you think is the outcome of this? Is it positive overall or is it negative overall? So let's take an example. Let's say you do 100 transactions, and let's say the average winner wins you 10%, and you lose 25% of the trades, but the average loser loses you 70%. So you have 100 transactions where 75 were wins of 10% each. You have 25 losing transactions where each loss is 70% of each transaction each. Overall portfolio will make minus 10% in this case, even if you had more number of wins a bit, in your year, because the losses are big and wins are small. So even though you had more number of wins, the larger losses over over the entire period of the year, engulfed those gains, even though they were larger in number. Again, the next contra question would be, can you still have a positive outcome with a win rate of only 15%? So you did 100 transactions in a year, you only won 15% of them. So 15 transactions went right, 85 transactions went wrong. But can you still win the game? Yes, you can. Let's say your average winner made you 150% on each transaction, and your average loser lost only 10%. Overall portfolio returns will be 14%. So if you bet, let's say 1% on each trade, uh, I have hit something. Okay, let me just get rid of this. So if I have, let's say, 1% uh, exposure on each trade, but each uh, trade which went positive made me 1.5%, but each trade that lost 10% lost me 0.1% only on every 1% exposure to that. So overall returns will come out positive, even though only 15 times I made a gain, whereas 85 times I lost, because my losses were very, very small. So the question is, what is an ideal win rate? What is the ideal average winner? Should loss percentage be contained within any specific number? Should the average loser not exceed the average winner? So there is, all kinds of setups that can happen. There is no one fixed answer. The best of traders in the world average somewhere around 30 to 40% of winning percentage. So only 30-40% of their transactions go right. But in those 30-40% of transactions, they make huge gains. And in the rest 60% losing transactions, they make small losses. That is the usual book of a good trader, a good investor also. So the only thing that you need to do is these two metrics, the average win rate and the win loss percentage, both combined together, if they can give you a positive expectancy, then your system will win over time. So let's now also see what is happening in weekend investing strategies. I've chosen three strategies which has been the longest running in live environment since 2016: MI25, MI30, and MI50. Since 2016, we've had 125 gainers in MI25, 176 losers in this strategy. So winning is only 41% of the time. 58.5% times we are losing. But each win has an average winning of 58%. So some may have been 100% gain, some may have been 20% gain, some may have been 10% gain, some may have been 300% gain. But the average winning transaction yielded us 58% on each of those transactions, whereas the average losing transaction lost us 13.69%. So again, you can see that over a very long period of time, and this is more than 7 years, uh, the average loser is like 1/4 of the average winner, and the winning rate is only near 40%, 41%. So CAGR still is 29% on this basis. MI30, MI25 is a small cap strategy. MI30 is a CNX 500 based strategy, and a all cap strategy in a way. Here we had gainers at 167 gainers, and these also include the current gainers. So stocks that we have not booked profits in, this that is those are also included in these gainers and losers. So 167 gainers, losers are 206 losers. Winning percentage here is more, 44.7%. Average winner is 31%, average loser is 10%. So 1 is to 3. So when we win 3 times bigger than our average loss, but our winning rate is only 44%, 45%. So we don't even win 50% of the time, but whenever we win 3 times on average more than our losing trade, and CAGR long term is 17.8%. MI50 is a mix of small cap and mid cap strategies with 50 stocks in the up to 50 stocks in the portfolio. Here, the gainers have been 206, losers have been 316, and winning percentage has been less than 40%. So 39.46% is the winning percentage. But see the average win, it is 54% versus 11% average loser. So almost 5 times is the average winner versus the average loser, although the winning rate is only 40%. Out of 100 transactions, we only win 40 times, but in each of those 40 times we make 5 times more than what we lose. So there is a CAGR of 24%. So there is a if you combine all of this, some learning or insight is coming out of all this, that you should be looking for large winners, small losers always. I mean, this is something that should, if you're designing a strategy, that should be your aim, that you allow your winners to run and allow your losers to be cut very very quickly. That is one side. And then you have to have a, even if you have a low win rate, that is okay, but high loss percentage is something that you want to avoid. So as you get as close to 50%, some people can even go to 60% in terms of win loss rate. But even if you are between 35 and 50, that is good enough, as long as your average winner is bigger than, much bigger than your average loser. So this is all that I had for today's session. Just closing remarks. Most weekend investing strategies are designed to have few wins and many losses. Win rates hover around 35 to 45%, but the edge is in keeping the losers very small and getting out of it without any emotion as soon as we can, and allowing the winners to run far and big, giving them a chance to become multi baggers. Thank you so much for watching this episode, and I'll see you in the next one. Bye.